The part that surprised actually was core inflation, and you're not hearing a lot of people talking about this. This is the Federal Reserve's most important indicator as far as they're concerned, what they continue to share with us. And so this excludes food and energy prices, and then their allocation of percentages of each cost. And that actually went up here this month.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm your host, Kerry Lutz. It's 12/12/23. David Stryzewski is with us, and we're talking about the CPI numbers. Can you trust them? Can you trust any government numbers? Well, maybe they're not quite as bad as China's, but when that's the best you can say about them, you got to think. David, welcome back. So CPI, what's the deal?
Hey, great to be with you here, Kerry. So first, the Consumer Price Index represents a basket of services that the government has ultimately determined to be a gauge of expenses or costs that people are spending money on. And so we'll talk about the fallacy of that in just a minute. But we just saw a reading that, CPI came down from 3.2 to 3.1 this month. Okay. So that's some movement, not huge movement. Of course, we're expecting, fluctuations. But the big reason for that lower reading was that energy costs went down about 6%. So, I think that we're all recognizing that here at the gas pump that, whatever reason, gas prices are, below 70 a barrel right now. The part that surprised actually was core inflation, and you're not hearing a lot of people talking about this. This is the Federal Reserve's most important indicator as far as they're concerned, what they continue to share with us. And so this excludes food and energy prices, and then their allocation of percentages of each cost. And that actually went up here this month. So that's now at 4% year over year, which is a long way from 2%. Big expenses within that were as a result of transportation being up over 10% over the year, and housing being up 6.5% year over year. Which of course housing right now is basically at its most unaffordable time in U.S. history. And so let me just talk about CPI for 2 seconds, and just for your listeners, there's a couple of problems with how they measure CPI. So number one, this is not a measurement of any specific consumer spending, let alone what the average American spends. That's kind of an interesting thing because, the market's been rallying on this new news that, hey, we got this lower number coming out, even though it's not applicable to any individual. But what CPI fails to recognize today in a big way is the cumulative inflation that we've seen since January of 2020. And so if we actually look at the cumulative inflation, we'll recognize 23.02% as of this morning on trueflation.com, which I personally ascribe to as a good indicator and a way to be tracking and watching things. But 23%, I mean, this is the reason why we saw over 300 strikes this year from all these companies and unions. It's because the wages that people are receiving today are not keeping up with the prices of everything else. And now that we're negotiating these new deals with auto workers, with teachers, with Hollywood, et cetera, are prices going to go down or up if we have to pay higher wages, higher benefits? No, they're of course going to equate to higher prices, which ultimately leads to higher inflation. So I think that the inflation story right now is about as cool as it's going to get. And from here, it's going to continue to rise. Even how we measure this thing, as I've just been noting, most economists that actually study this stuff and are, maybe a little bit more critical of the data, they refer to this as the CPI. It doesn't include taxes. It doesn't include any basket of things that anyone's specifically buying here. So, don't put too much weight into these numbers, but I would just recognize that they have not gone down. And a big part of that is what they would refer to as the lag effect. It takes time for these rates to rise and stuff to hit. I think things are about to hit right now. and it doesn't really spell a great 2024 here as we're heading into that new year.
Okay, so it's looking pretty bleak, huh?
Well, yeah. So if we look at some of the indicators that would give us understanding for where we're headed next, we should understand that our gross domestic product, what's the U.S. produce, what do we do? 70% of all GDP in the United States has been the consumer, as you and I know I'm talking about. But in 2024, it's going to be this consumer is going to be much weaker. Why? Well, we've got over 1.2 trillion in credit card debt at record high APRs. I mean, let's just be honest here. Who is doing that and putting, payments on a credit card at a 23, 24, 25% rate? No one would ever do that and think this is a really good idea. They're forced to do it because they don't know how to budget. We got student loan repayment that just began here in October, which is a big deal for those that, hadn't had those payments. And then, they took on more debt, got a new car, got a different house, whatever. And then ultimately, housing, as I mentioned earlier, never been more unaffordable as it is right now. So I personally think that housing is going to go down. But if you look at the price to rent versus a mortgage, and you don't even account for the down payment that it takes to buy that mortgage, you've got a better deal right now renting than purchasing that mortgage. It's nobody's market right now here in real estate, in my opinion, other than, places like Florida, like where you're at, there's still some opportunities, showing up. But if you look at the consumer today, more and more people, if you look at these jobs numbers, they're losing full-time jobs and taking on second and third part-time jobs. And so this is not a good sign for the American consumer, for the middle class. And then ultimately, my opinion of 2023 is that, this is the most anticipated recession in our history. And we were expecting it here in 2023. But, we were also expecting that, they were going to be cutting rates by July. That didn't happen. Now it's supposed to be, sometime mid next year. But the reason that things actually really didn't crash yet was because that they put $1.2 trillion in the consumer's hands, who has the biggest dependency to spend. That would be business owners. So PPP and employee retention credit loans came in. We bought real estate. We bought lots of stuff, hopefully invested back into your companies. But this has delayed that lag effect. And so, if we look at the employee retention credit, which is the last, kind of like giveaway here, that all ended September of this year. So July was the biggest month of payments, and then it ended in September. And so we had this amazing, GDP number for Q3. Well, I was taking a walk here the other day. It's a little bit cold here in the greater Seattle area in comparison to what it was like in Q3 July. I think that we're in a different climate right now. And in my opinion, Q4 is likely going to be this time frame that we recognize some of the bad data, some of the data that would show that negative things are occurring. We're getting weaker. We're always looking in the rearview mirror. I think Q4 is when it's really going to be coming out here, and they're probably going to name that the beginning of the recession.
You think so, huh?
I know it's a strong statement.
Yeah. How bad is this recession going to be?
That's the $1 million question. Recessions come and go. They're normal. They're good for the market, actually, to have, things flush out, then healthy things grow back in, just like pruning is a good thing. So a global recession, though, that is more of a rare event. And we're seeing globally a shutdown right now. I mean, Germany's in recession. Japan's on the verge of recession. Canada's on the verge of a housing recession. China is in massive trouble right now. Of course, they hardly report their information correctly. And so, how bad is this recession going to be? I think that when we look at this thing objectively, we have to recognize that in March this year, just 9 months ago, we had a banking crisis begin. That banking crisis resulted in the most significant bank bailout in the United States history. And so this is just 9 months ago. And we if we understand, kind of what that looks like, where that leads, I personally am seeing that, March this next year is likely going to have a lot more of the bank challenges, especially given the fact that these banks just don't have capital to lend any longer. Because people move to treasury markets. They can get FDIC to 100% of their money, not just 250,000 of it. But here's the thing that most people have not factored in as well. and that is that most CFOs, their job is to secure low-cost lines of credit. And so if they could refi their debt in 2018, 19, 20, 21, and they could get in at 3-4% on loans, that was a really awesome thing, and it caused our economy to really grow. But what happens is that debt has to be remetabolized every 5 years. So it's a 30-year amortization schedule, but it usually resets every 5. Well, what that means right now is that, coming somewhere around, 2024, 2025, 2026, we have record levels of debt, trillions of dollars that are coming due. And these dollars coming due are going to be having to either be paid off in full or, recast at higher rates. And ultimately, that's going to cripple these companies because their margin, what they had to operate on previously, was based upon a low cost, debt is plentiful, high liquidity, time frames. And so I personally see a financial crisis occurring at the same time as a recession.
Wow.
Now, if those things coincide, and if this takes place over the time frame that we're expecting here, another lost decade is definitely not outside of the purview, especially when we're about to hit 34 trillion in debt here, by December 22nd this year, according to the numbers I was looking at. So, that combine that with China and its saddle sort of rattling that's going on right now.
Yeah.
You got the United States dollar and the BRICS pay, which is this new system that comes out January 1. They haven't announced that BRICS pay is going out January 21, but I can say this much: the Saudis joined the BRICS January of 21 or 24, and when the Saudis join, I personally believe that is the end of the petrodollar. Why? If you Google or Wikipedia with BRICS Pay, it literally talks about a payment system that Brazil, Russia, India, China, South Africa, and the plus nations that are joining right now are looking at creating a settling currency. This isn't for them to go buy milk and eggs. This is to settle trade amongst nations. They're buying thousands of tons of gold right now, trying to back up their currency and their financial standings. They're not buying U.S. dollars anymore. I believe that the U.S. has a real rival at a time when we have massive debt, our banking's in crisis, and ultimately our adversaries are becoming weaker and weaker, which tend to put people in places where they could act erratically, like WW3 type of activity, which I pray, and we all need to pray, that this stuff doesn't really and actually unfold, especially given the fact that we have an open border and millions of undocumented people now in our nation that never got fully vetted. So I could lay out a really, really nasty and bad scenario here, which unfortunately seems more probable than not on every level, that's going to result in bankruptcies and a lot of pain and carnage here for stocks, as well as the bond market. Bond market's going to get hit really, really, really hard by this, actually.
All right. Well, you're a breath of fresh air today, David. So, what are you supposed to do about all this, since most of it is out of our control here?
Right. Well, so that is the question. My belief is that traditional buy and hold, park and pray, hope everything will be okay strategies, while they work when times are normal and good, they do not work very well when times of disruption are occurring. And so we need to allocate in a more specific way, and we need to be looking at a higher amount of commodities today. Gold and silver are going to for sure be the winners throughout this. I think treasury bills look all right, but you're buying future promises for U.S. dollars, so I wouldn't get too long on that. But we look at oil producers. I think oil producers are actually going to do really well. They pay really good dividends. They definitely won't stop those if they can help it. We got some international plays today that can be really valuable. India, as an example, is probably a multi-decade story. They were just our back office before. Now they're becoming more of a manufacturer, and they've got these very educated people that are graduating from college. I think that as people are looking at allocation strategies, they need to be very, very, very wise as they look at their bond allocations or fixed allocations. And the reason for that is, if bonds can lose money in 5 different ways. And so we've talked about this before, but these 5 specific ways are actually all 5 raising warning signs right now, which causes considerable concern for me So we need alternatives to bonds very specifically because, the ultimate, form of loss here is default and you get nothing back. So that's the part that we really need to be cautious about. So I think if people are looking at, more fixed assets, treasuries can work out short-term very specifically, or I actually believe that there's never been a better time to own what's called a growth-oriented fixed indexed annuity. It gives you essentially the ability to make reasonable rates of return on the upside, but more importantly, none of the downside when the market corrects. And so we've been allocating people to these types of products, which are actually insurance contracts, as alternatives to bonds, and they've been working out exceptionally well. When you can get, let's just say 60% of whatever the market does, but none of the downside, that surpasses what most people believe their fixed portfolio is going to do, especially because there could be actual losses like we're about to see here for the third year in a row as the year closes out on bonds. So yes, sir, wow. I do.
All right. Well, hey, we always appreciate your take on things. These are difficult times for sure. Mm-hmm. And you need to do what is necessary. Do you think any of these insurance companies writing these annuities are going to fail?
It's a great question. How the insurance companies have to work, though, is that they must insure and have dollars in reserve, one for one with the investments that are being made. And so in our nation's history, we have not seen even one of these contracts, somebody not get paid back. There's only one failure that's ever occurred, and it was because they were really running their books funny. Insurance companies certainly could have challenges because, hey, they bought into the same long-dated treasuries that the banks did and the pension companies, et cetera. But the good news is that the reserve requirements make them the most conservative places to be putting money. And, here in the great state of Washington, which I personally live in, we even have a $500,000 per account per policyholder guarantee. That's kind of like FDIC, but it's, the state of Washington actually backing it up. And God forbid these companies actually went out of business. Most people are not aware that as a taxpayer of that state, you actually would be responsible to make those people whole up to the guarantee issue levels that the state has, the insurance commissioner has created. So it might have some more safety than people specifically are looking at. But I also love the idea that we can dollar cost average out of these accounts, typically about 10% a year, back into the stock market when everything goes on sale. And so our strategy is we're going to actually make a lot of money as the world changes. We just need to be able to make money in sideways markets. So we do that through what we call riding bulls and taming bears.
All right. So sometimes the best way to tame a bear is just to avoid it altogether, right?
Yes, sir. That's exactly right.
All right. David, where do we find you these days?
Yeah. So my website is myspg for sound planning group.com. And I've actually got a new book that'll be coming out here in the first part of the year called Riding Bulls and Taming Bears. I got a new class that'll be coming out called the Federal Reserve Bubble here in 2024. And so that's what I'm naming this next crisis. And I'm going to lay all of that out here in the book and in that class. And so people can find more information at myspg.com, or they can, put their name in and say, hey, love to connect and answer some questions. But your viewers are incredibly intelligent. And, I think that they would be wise to be taking heed to some of the cautions that I've shared here today, because I hope I'm wrong. But the reality is, if I'm right, those are game changer moments that ultimately affect somebody's outcome and their ability to retire and stay retired.
All right. Hey, we appreciate it. If you've got a question for David or myself, you can always email me, kl@kerrylutz.com. The link to David's site is on our site in the show notes to this interview, financialsurvivalnetwork.com. Make sure you sign up for your free newsletter. David, it's always a pleasure. Appreciate your stopping by, and we'll talk to you next month. Happy, healthy holidays, for lack of a more politically correct term, and a healthy year to you and yours.
I appreciate you, Kerry. Blessings to you and your family, and look forward to connecting with you soon. Take care.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network. Now more than ever.